What is up, YouTube? What's up, guys? The Composer Trader here, and welcome back to another post trading analysis video. And today, I want to be discussing a trade I took on EURJPY around 2 weeks ago, which was a perfect textbook example of a TCT within TCT model entry. Okay. So we're going to be diving into the technical aspects behind this trade and also things that I personally could have done better. Now, all these trades are already posted and updated in real time also on my X. So if you want to see me more active and see the setups kind of in real time, then I definitely advise you to go to X, the Composite Trader, and follow me over there. And obviously, these trades have all been shared in advance inside of the TC trading community. So if you want to take these trades live with me, definitely make sure to check that out. Now, bring it back to EURJPY. Right here, it was a really, really, really good setup. So for the setup specifically, it doesn't really matter what the high time frame context is doing, right? Because we were simply in a range right here that is truly nothing but a range that had an untapped swing low and an untapped swing high right there. So no signs of any high time frame accumulation models on the macro range. Volume profile does not want to load right now, but you can argue that inside of the range, you already have a Model 1 accumulation schematic where the technical target would be a new high right there. But I always like it less when you have an internal range, meaning the range within the bigger range, being so big that it almost takes up the entire macro range. So right here, this is the macro range that I'm referring to. Okay, and this range itself is almost taking up the entire macro range from a vertical standpoint, right? So I don't really like that. When you have your macro range, you kind of want to look for models in the upper section and for models in the lower section. Because when you have a model that almost takes up the entire range, then it's better to just look at the primary points, which is the actual low and the actual high. So, getting a distribution model in here, even though you could have a model 1 accumulation schematic right there where the high time frame order flow objective is this high, it should not hold you back from not taking the high probability model on the lower time frame. I really got to turn these notifications off, but I need to check how. But yeah, so basically from a high time frame perspective, if we have to build some context, we were at around the volume area high, but the volume profile is not loading in the premium section. So that's simply enough. Okay, that's all that you need to know. Now, zooming in here on the lower time frame, this is where things truly become interesting because prior to creating the range, we can see price making higher lows and higher highs right here, simply having an uptrend. And in this uptrend, you can see that we're taking the highs, but we're not significantly breaking above the highs. They're mostly just deviations where the price is taking the highs over and over and over again, keeping all these lows intact. Now, if you watched my SUI video from yesterday, you will understand that this is sign of exhaustion. We're sweeping buy-side liquidity, leaving sell-side liquidity below. These markets love to rotate from buy-side to sell-side or from sell-side to buy-side. So having kind of this price behavior prior to coming into your range that you can pull from high to low because you're in that local uptrend, that's absolutely amazing because you can see price already kind of distributing coming into that range, making it very nice to have a potential high probability distribution model within the range itself, which is where the entry will actually take place. Okay, so we were trending up. Initial range high, initial range low, price comes back to the equilibrium, confirming the range, and from there we have that deviation 1. Now, personally, what I could have done better is I was looking at this price action, and I saw the tab 1 and the tab 2, and the return to zone right here locally already, when price was right there in the Asia session pulling back, you already had a very nice return to zone right here in the shape of a trend line. Now, you can argue, Lars, isn't that third tap from a time displacement standpoint very close to the second tap? Yes, it is, but because the return to zone is so good, where all these lows are still intact right here, literally all these lows are intact, Plus, you have a range inefficiency where you have no price action into the discount section of the range. You can already validate this as a potential tap as long as it meets the third tap requirements, which is sweeping extreme liquidity or mitigating extreme supply. So I was checking this out obviously later in the morning when I'm waking up, and I zoom in here on the lower time frame, and I thought to myself, okay, so right here we have this 5-minute supply zone right there in the shape of an OBIF, order block with an inefficiency. But then maybe on the lower time frame we already swept the liquidity, validating the third tap as well. And there wasn't really any liquidity to properly look at, right? Because this high right here, it's a bit too low. Like, you can technically look at this as the first lower high, but you can also say like, hey, this could be the first lower high technically. But I would say this is just a bit too low, and this would definitely be the better one, but that technically wasn't valid structure. So technically that's not your valid extreme liquidity POI. And the 5-minute supply was looking extremely good. But in the morning, right, because now I'm reflecting back on the trade, especially 2 weeks later. In the morning, I was like, okay, this can already be a valid tap, and this right here can therefore be the breaker structure, okay? Already confirming the model. And right here on that retest, you can actually see your Asia open. So the Asia session is represented in purple right here. And you can see that the lower high put in right after that breaker structure was also your Asia high. So I'm pulling up for the London session, right, which starts at around this blue price behavior. And I'm seeing this and I'm like, well, price can come back up and we can trade the fourth tap, creating an extended distribution model with your 1, your 2, your 3, and then the fourth tap needs to meet the same requirements as the third tap, which is either extreme supply or extreme liquidity. And in this case, it could be extreme liquidity, and that is also in line with your Asia high. And session points in the Forex market are amazing liquidity points as well. So I was looking at this and I was like, hey, this could be a 1, 2, 3, and then we can come back for the fourth tap. Now, I wasn't paying close enough attention right here on the breaker structure. So I wasn't aware of the break when the breaker structure actually occurred. And you can consider me lucky because that's the exact reason why I did not take an L on this setup initially. Because I kind of arrived when price already put in the first lower high for the lower low after the original breaker structure. And I was kind of tuning into the markets right here. So I'm like, okay, I would like to see a reconfirmation. Now, what do I mean with a reconfirmation? Is that basically here, price is making higher lows and higher highs on that lower time frame. We break that back to bearish. You know, price could be pulling back up for some extreme liquidity. I simply wanted to see price break back to bearish from this low to wherever that high might be. Okay, in this case, the high took place right there. So I was observing on a lower time frame the market structure from the low to the high, and that's where I never got an entry, because right here price was making higher lows and higher highs, never breaking back to bearish. We can skip over that point actually. Never breaking back to bearish, and then right there you had your higher low for the most recent higher high. Let me put it on the chart properly. So we had this, and this right here was one candle close below, but it immediately shot back up. And just because we already took so much time to travel from the high to the low, you know, whenever price takes a lot of time, and this is where a lot of people actually get trapped entering on the breaker structure. Right here, you can see that price already has to spend 1, 2, 3, 4, 5 candles, 5 consecutive bearish closing candles in order to reach that market structure low. When price has to travel such a long distance to break market structure back to bearish, having 5 consecutive bearish candles in a row, and you enter on that immediate close, well, you can expect price to get a relief back up, even if it's intended to go lower, because it already traveled such a big distance in order to come towards that market structure low in the first place. So whenever I see that, especially on the lower time frame, I like to just chill and kind of see what the second candle does. And the second candle right here immediately shoots back up. So I'm just patiently waiting, extending that market structure low to this low right here, waiting for a potential second bearish break of structure entry. And now from here, right, price was putting in that high, and we put in a lower high, a lower high, a lower high, a lower high. And you can kind of see that instead of breaking structure, price was actually creating a low time frame accumulation model, leaving all these highs intact. So the moment this happened, I'm like, oh yeah, this is shooting back up. Okay, this is definitely shooting back up. And we still have that 5-minute supply that price could come back for. Now, the problem was that this ended up turning into a new range. That's amazing, okay? Where you have that initial range low, have that initial range high on the higher time frame. You can validate that right here, on the 10-minute time frame. You can see all that lower time frame breaker structure behavior is all disregarded on the 10-minute, and you simply have a higher low for the higher high like this, and you could get a Model 1 distribution schematic, which is exactly what we got, right? A Model 1 distribution schematic that creates the third tap of the higher time frame distribution right here. Just like that. That is the perfect representation of TCT within TCT, because you have your own high probability Model 1 distribution in the third tap of the higher time frame distribution. So you have your 1, you have your 2, you have your 3, and this third tap itself has its own 1, 2, and 3, okay? And that allows for very refined entries. Now, the problem that I had, now looking back as well, is that typically when you have a confirmed Model 2, right here with the 1, 2, and the 3, I don't like it when your confirmed Model 2 goes over in another Model 2, but you just change the third tap POI. Typically, when you have your Model 2 and it gets taken out, so this high gets taken out, you go over in the Model 1, just based off experience alone, okay? Now, the problem is that now looking back, I'm like, why was I so obsessed with already calling this a Model 2 distribution per se? Because, like, if I zoom in, you have a very obvious third tap POI right there. And this liquidity grab, it wasn't even structure. And technically speaking, this was the first lower high for the lower low that got created right there after putting in the second tap that also has a POI unmitigated around that tab 1, which is an amazing POI for your third tap to take place. So, and the time displacement was, shorter here, and obviously it's easier to talk in the aftermath, but I'm looking back now and I'm like, it's like, it's a pretty obvious POI to wait for, I think it's just because the buildup was so nice that my mind potentially subconsciously tried to trick me into already entering here, which I didn't even get an entry for in the first place, because I was expecting a rotation back down. And that expectation ended up being right. But when I see a Model 2 going over in another Model 2 on the same time frame, I enter with lower risk. So I was observing right here. I was aware of the Model 1. We were watching it all live. Lots of people actually passed their funded account with this one. Shout out to Mr. Yessa, who passes funded account in one trade with this trade. But yeah, I was observing price action here, and I was following the structure right there, being the market structure low, following the higher low for the higher high, just like that. And right here we got that breaker structure confirming this Model 1, and therefore on this low time frame breaker structure right there, you can confirm the rotation back down all the way towards this range low, making for like a 1 to 13 RR. Now, I took it with 0.5 risk. Okay, I took it with 0.5 risk because of the scenario where I was thinking this was just like a Model 2 going over in another Model 2. But actually, it was a super high probability model because you have a Model 2 distribution with TCT and TCT. You have a high time frame return to zone. And again, a range inefficiency. There's no price action in the discount section of this range, meaning once price truly decides to go down, it will probably go down pretty fast. And you can see it went down pretty fast. There's not that much to hold price up. But I was a bit sketched out because of that Model 2 into a Model 2 narrative. And then right here, I was thinking, man, like we have a 1, we have a 2, we have a 3, and we broke that structure back to bullish. So I actually de-risked the position, took a tiny partial up there because I was like, we're coming down slow and this could reverse into a Model 1 accumulation. So I took a tiny partial profit and then simply left the position open right there, trailing the stop loss to that retest high. And I ended up netting 4% on this trade. So a 0.5 risk on the 13 RR is around 6.5%. And because I took that partial, that got diminished to 4 RR, which is still amazing. But looking back, I'm like, this should have been like a 2% risk type of play because it's so clean, you know? So it's great to reflect back on it, especially 2 weeks later, because it truly brings you back to like why you were looking at that in the moment. And it can give a lot of clarity actually. And all this price action in here is just noise, right? You're just going horizontally, sweeping sell side, buy side, manipulating. But the high time frame order flow objective once the breaker structure happens here is to come to here. So any moves up in here should be looked at as short opportunities to take towards that technical target, which is the range low. So this model played out right here, and you can see it was absolutely amazing. You can see the entry right there, the timing, the entry, the profit multiplied by 4. It was an amazing trade either way, despite it only being 4R. But hey, if you watch my video on how to make 1,000 or how to turn 1,000 into 100 million, you know how effective 4Rs can be. And it's actually pretty funny to see now that we talk about these distribution models creating higher time frame ranges all the time. And you can see that distribution model that we traded and that move down that we got, that actually delivered and is right now creating the range high for the higher time frame range with your tab 1 and your tab 2. And we're right here now waiting for a potential move back up, sweeping that extreme liquidity for a tab 3. And you will see this all the time, right? Where this distribution model, the purpose of that distribution is to create the higher time frame range high for the range low, and then create a higher time frame distribution model with your 1, your 2, and your 3. So it would be very nice price behavior on EURJPY here if we can get a rotation back up to around 163.4, sweep that liquidity, break structure back to bearish, and then we will have another entry for the rotation back down. Something like this, short on the breaker structure, stop loss above that third tap, and rotated back down towards the technical target, which is the range low. So, it will be kind of needing to go up from here slowly, leaving that return to zone intact. Otherwise, it's a bit too deep of a retracement. But that's what we're currently watching now. So you kind of see how this developed in the future. And I appreciate you guys for watching. Again, we take these trades live inside of the TCT trading community. So it's literally the best ROI that you can make for yourself. It's like such a cheap monthly fee, and you can take one trade and make your yearly membership back. So I highly advise you, if you watch these videos and you like my style of trading and you want to know more, dive into the high probability lectures inside of the VIP community, and a whole new world's going to go open up for you. Okay, people are active. You can see the messages coming in every single time I try to record. I'm gonna look for a way to turn that off, and I appreciate you for listening, and I'll see you all in the next one. Peace out.